If you rented out your car on Turo in 2026, the IRS considers you a business owner. But most Turo hosts don't realize how many deductions they're leaving on the table. In the next 8 minutes, I'll show you exactly how to file your Turo taxes, the 2 deduction methods you need to choose between, and how hosts are legally saving thousands every year. Note: this information applies to US-based Turo hosts. Welcome to the Freelancer's Wealth Blueprint. Let's get your Turo taxes right. First, how does Turo income work for taxes? When you rent out your car on Turo, you're not an employee. You're an independent contractor running a car rental business. Turo doesn't withhold taxes from your earnings. That's your responsibility. You'll receive a Form 1099-K if you earned over $20,000 and had more than 200 transactions on the platform. Both conditions must be met. But here's what catches people off guard. Even if you don't receive a 1099-K, you still owe taxes on every dollar you earned. If your net profit is $400 or more, you must file and pay self-employment tax. One important detail about your 1099-K: it reports your gross payouts, not your net earnings. That means it includes Turo's service fees before they were deducted. So the number on your 1099-K will be higher than what actually hit your bank account. Don't panic. You'll deduct those fees on your tax return. What taxes do Turo hosts owe? As an active Turo host, you owe 2 types of tax. First, self-employment tax at 15.3%. This covers Social Security at 12.4% on the first $184,500 of net earnings, plus Medicare at 2.9% on all earnings. Second, federal income tax based on your tax bracket. Most Turo hosts report income on Schedule C because the average rental period is typically 7 days or less. If you're actively managing your listings, setting prices, and maintaining your vehicles, the IRS considers this business income subject to self-employment tax. Now here's where Turo gets interesting compared to other gig platforms. You have 2 methods for deducting vehicle expenses, and the one you pick can mean a difference of thousands of dollars. Method 1. Standard mileage rate. The 2026 IRS standard mileage rate is 72.5 cents per mile. You track every mile your car is driven while rented and multiply by the rate. This method is simpler. You just track rental miles. But for many Turo hosts, it's not the best option. Method 2. Actual expenses. This is where the real savings happen. You track every dollar you spend on the vehicle, then deduct the percentage used for Turo business. Deductible actual expenses include car payments or lease payments, auto insurance, maintenance and repairs, car washes and detailing, gas and fuel, registration and license fees, parking and tolls, and the big one, depreciation. You calculate your business use percentage by dividing rental days by total days in the year. If your car was rented 200 out of 365 days, your business use percentage is about 55%. For most Turo hosts with decent earnings, the actual expenses method produces a much larger deduction than standard mileage. But you must choose in the first year you use the vehicle for business. And if you choose actual expenses, you cannot switch to standard mileage for that vehicle later. Let's talk about depreciation, because this is the biggest tax advantage for Turo hosts. When you buy a car for your Turo business, you don't deduct the full cost in 1 year under normal rules. Instead, you depreciate it over 5 years. But here's the game changer. Under the One Big Beautiful Bill Act, 100% bonus depreciation is back. That means if you bought a vehicle for Turo use in 2026, you may be able to deduct the entire business use portion of the cost in year 1. For passenger vehicles under 6,000 pounds, there are annual depreciation caps. With bonus depreciation, the first-year limit is approximately $20,000. Without bonus depreciation, it's about $12,000. For vehicles over 6,000 pounds, like full-size SUVs and trucks, those caps don't apply. This means you could potentially deduct a much larger amount in year 1. Key is your business use percentage. If you use the vehicle 60% for Turo, you can only depreciate 60% of the cost. Now let me walk through the other deductions every Turo host should claim. Turo service fees. Turo takes a percentage of each booking. This is fully deductible. Check your earnings summary for the exact amount. Insurance. Whether you use Turo's protection plan or carry your own commercial auto insurance, those costs are deductible based on your business use percentage. Maintenance and repairs. Oil changes, tire rotations, brake pads, engine work. Any maintenance needed to keep your rental vehicle running is deductible. Cleaning and detailing. Car washes, interior detailing, air fresheners, cleaning supplies. You need a clean car for guests, and those costs add up. Parking and tolls. If you pay for parking while positioning your vehicle for pickup, or pay tolls related to your rental business, save those receipts. Phone and internet. You use your phone to manage bookings, communicate with guests, and check your Turo dashboard. Deduct the business use percentage of your phone bill. Supplies. Key lock boxes, phone mounts, car chargers, floor mats you provide for renters. All deductible. Health insurance premiums. As a self-employed person, you can deduct 100% of your health insurance premiums. This includes medical, dental, and vision. Let me show you a real example. Marcus is a Turo host with one vehicle. His 2026 numbers, gross Turo payouts reported on 1099 to K, $22,000. Less Turo service fees, $3,300. Net earnings from Turo, $18,700. His vehicle was rented 210 days out of 365. Business use percentage, 58%. His actual expenses, car payment interest, $2,400 times 58% equals $1,192. Auto insurance, $1,800 times 58% equals $1,044. Maintenance and repairs, $1,200 times 58% equals $696. Cleaning and detailing, $800 all business equals $800. Gas for guest trips, $600. Depreciation, first year with bonus, $11,600. Turo service fees, $3,300. Phone, 30% business, $360. Health insurance, $4,200. Total deductions, $20,992. Net profit, $18,700 minus $23,992 equals a net loss of $5,290. That's right. Marcus actually shows a tax loss on paper, primarily because of depreciation. Depreciation is a non-cash expense. He's still putting real money in his pocket from Turo, but the IRS lets him deduct the wear and tear on his asset. This law can offset his other income, potentially saving him thousands in taxes. If Marcus had used standard mileage instead, his deduction would have been significantly smaller. Don't forget quarterly estimated taxes. If you expect to owe $1,000 or more for the year, pay quarterly estimated taxes to avoid penalties. Deadlines are April 15th, June 15th, September 15th, and January 15th. For your first year on Turo, set aside 25 to 30% of each payout until you know your actual tax situation. Here's the bottom line. Turo hosts have some of the best tax deduction opportunities in the gig economy, especially with depreciation. Choose the actual expenses method if your numbers support it. Track every expense. And don't forget about bonus depreciation. The difference between Turo hosts who overpay taxes and those who keep more money? Understanding which deduction method to use and keeping good records. For more on quarterly estimated taxes, check out our complete guide. Link in the description. This video is for educational purposes only and does not constitute tax or financial advice. Consult a qualified professional for your specific situation. See you in the next one.